Welcome back to another video. Today we got a quick one, and I wanted to get this message out not only to the current subscribers that are already believers, but this is a video that you can send to your people that are afraid to start investing. And in my opinion, that is one of the worst things that you could do for your family tree, is be afraid to invest because you think you're going to lose money. Being afraid to invest, in my view, it's basically being afraid to have wealth, being afraid to be an owner in the economy rather than a consumer of the economy. And I'm about to show you guys why. So a lot of people come up to me and they say, I want to get started investing, but they don't want to lose money. And what I would tell them is, you're already losing money. So what we've got here in front of us is a chart of the US dollar over the past 100 years. Okay, so let's just take a look at from 1940 until 1970. So 1940, we've got about $12 here on the purchasing power, but you go down here to 1970 and we can say that that's about $4. So you got about a third of the purchasing power. So if you held dollars, you could purchase a third as much as that. So think about it. Who holds dollars? People who hold dollars are people who don't own businesses. They don't own real assets. They don't own any real estate, things like that. So the people that are hurt the most by the fact that the dollar is being devalued are people that are holding dollars, people that don't have anything else to counteract the devaluation of the dollar. So let's check out a look of the S&P 500 over this time period. So this is the past 90 years of the S&P 500. So let's go to 1940. 1940, we're sitting at about 200, 220, let's call it 225, all right? So S&P 500 is at 225. We go forward to about 1970. We're going down a little bit there, and we're at about 565. So let's just call it 550. So you basically doubled your money over that time period if you invested in the S&P 500. And the reason behind that is because these businesses, as they produce products, even if the money supply goes up, these businesses just raise their prices. So a lot of these monetary policies that pump more money into the system, it doesn't really matter how much money you pump into the system. It's like cutting a pie into a bunch of different slices. The people who get the money are the people who make things that people are willing to buy. So if you're owning businesses, you're owning things that people are willing to buy. So owning a business is more so just protection against the fact that currencies are being devalued and you actually own something that's of value. So as you see, this chart, it basically looks like the inverse of the other chart. If we go back here, so this chart, you lose 66% of your purchasing power. This chart, you double up your purchasing power. So in nominal terms. So basically, if you don't own businesses, you don't own the things that dollars actually buy, you're essentially being left behind by the financial game. Because if you are owning those dollars don't actually have any meaning. So the actual businesses, the things that you can buy, that you should buy with those dollars, are what actually has the meaning. So if someone asks you why you're investing, somebody asks you if you're worried about losing money, you should tell them that they're already losing money. So hopefully that helps some people out there. And then I want to show you guys correction. So let's look up the definition of a correction. Basically, a correction is a drop in the stock market of 10% or greater. All right. So an average correction of the S&P 500, which is the 500 largest companies in the US, lasted for only 4 months and values fell around 13% before recovering. Now let's go down here. I want to show you guys something else on this correction page. This is Investopedia. By the way, Investopedia is a great resource if you guys want to learn more about investing. So market corrections occur relatively often. So these are common. Between 1980 and 2018, the market experienced 37 corrections. So look at that, 38 years, 37 corrections, right? So how often do we think a correction is going to happen? Pretty often, right? It looks like about once a year. The S&P fell an average of 15.6% in that time period. 10 of these corrections resulted in bear markets, which are generally indicators of economic downturns. The others remained or transitioned back into bull markets, which are usually indicators of economic growth and stability. So now I want to show you guys, I've showed you guys that these are common. These happen all the time. So trying to avoid it is basically like trying to avoid a year. If you got 38 years and you got 37 corrections, we know that corrections are coming. We also know that if you don't invest, you are going to lose money. So let's go to this next thing, and we're going to look at, these are the top, 20 biggest stock market drops. So I want you to notice a correlation here. All right, 1929, that was the Great Depression. Look, the Wall Street crash right here, 1929, 1929, 1929. All right, now let's look at the biggest gains in the market. Guarantee we can find 1929, 1929. Let's see down here. Any more 1929? No. What else do we have? We have the global financial crisis. All right. This was the housing bubble. When the housing bubble burst, stock markets crashed. 2008, 2008, 2008. We've got a bunch of the biggest red days. Let's look over here. The biggest green days, 2008, 2008. Same thing. 2020. We know what happened in 2020. COVID-19 crisis. 2020, 2020. Look over here at the biggest green days, 2020, 2020, 2020. Look at this flash crash of 1987. Look at that chart right there. Okay, Black Monday. It went straight down and then it recovered, right? So 1987 over here. You look over here, one of the biggest green days in the market, eighth greenest day in the market, 1987 rather. All right, so we're seeing the correlation here. Right after the market drops the most, it recovers the most. So we're seeing pretty easy waters right now in the market, so I wouldn't be rushing into the market right now. Everything is relatively calm. Everybody's pretty happy about the stimulus package. But if we do start to see some heavy volatility, some really big drops, anybody who has seen this video, anybody who understands that the biggest drops come with the biggest recoveries, they know that these are the times where they're going to become a millionaire. These are the times where you're going to change your family tree, because you know that when everybody's freaking out, when everybody's running around with a chicken, like a chicken with their head cut off, when everybody's selling all their stocks, when everybody's saying, oh, you're losing money, even though people are only losing money on paper, you were the one who was buying. You were the one who was looking for extra opportunities to go out there and work even more, put even more money in the market during those drops, because you know about this green side. You know that things recover very quickly. And anyways, that's what I wanted to get across with this video. Hopefully this helps somebody out there. Hit the thumbs up button if you guys enjoy this type of content, and I'll see you guys in the next video.